All right, everybody. It looks like we are live on YouTube. We're definitely live on X. I see some clicks starting to come through. Appreciate you guys meeting us tonight. It is an emergency meeting specifically around Venture Global. Maybe we'll get into some of the other LNG plays that we kind of have been looking at. But we've had some people reaching out to me. I know, Chris, I'm sure I saw you in the chat earlier today, chatting with folks as well. Large pullback on Venture Global based off of what I thought was gossip. It's not really news because, anyway, we can get into it a little bit later. But I thought it was pretty funny if that was the reason, but I don't think it was because the entire LNG market, Cheniere, Next Decade, Venture Global, a lot of those companies pulled back today. So I don't think it's a one-off. For those of you that don't necessarily know what I'm talking about, Venture Global is a company that IPO'd within the last 2 or 3 weeks or so. And I've written some stuff about Seeking Alpha about it. I've let my members know about it a good bit. I've talked about it a little bit on some streams. And I know Chris is the one that kind of even let me know that was coming down the radar. I'm in the industry. I know Venture Global. So I was very intrigued when they're announcing their IPO. And Chris had kind of let me know about that. So let me just kick it down on the actual stream. I'm curious to get Chris's initial thoughts as to where he might want to take this. Now, of course, a little intro, February 6th, 2025. Always good to have you guys here. Subscribing will allow you to chat in the chat box for free, although you can always become a member of Chris's and I's Patreon in the description. We have Apple 233, Amazon 229 down after hours. Dutch Bro still on a massive run, $67. Google pulled back, as we know, yesterday, 191. Palantir up about 10% today, believe it or not, 112. SPY 606, the Q's 530, Bitcoin 997. Sorry. Oil just about to break into the 60s, and Henry Hub gas $3.37. Mr. Patel, sorry for my long monologue. How are you doing?
Good, man. We're about to go on a journey. It's going to be a 2-hour, maybe 3-hour journey. And I think it's going to be eye-opening. I'm super tired, but I'm going to try to get us through it. So I think the first thing we need to do is explain the business model that is liquefied natural gas. If you don't know anything about liquefied natural gas, it's going to be hard to basically talk about certain things that we talk about. And so I say you guys have to really, really pay attention initially. Once you get the basic concept, it's not that hard to explain. So where should we start off? Should we start off with Sharif Suki? I think that's a good place to start. What do you think?
Yeah, that's a good one. I didn't realize you were going to go that far back, but I'm all about it.
Okay.
The Godfather.
The godfather of liquefied natural gas, Sharif Suki. So back in the day, it's like the 2000s, people, countries all around the world, they would use, natural gas, but the way that they would use it was a little bit complicated, right? Basically, if you didn't have local natural gas supplies, you would have it piped in. Some parts of the world had ready access to it, like Russia, us to some degree. But for the most part, if you're going into the energy economy, you're using up a lot of energy. And one of the sources was natural gas. Now, the United States at the time was this guy, his name is Sharif Suki. He thought, hey, I have an idea. What if I built terminals that would basically take gas from other countries and then regasify it? Basically, they would take liquefied natural gas from other countries, bring it into the United States, regasify it, and then send it all across the country. So that's what he did. He went to the banks. He said, listen, I need some money because there's an opportunity where Americans are going to need energy. And I want to build this terminal that basically regasifies things. Before that, the Qataris, got to give us some credit to them. They discovered that there was a profit to be made because Qatar has a lot of natural gas. So what they did is they figured out that, hey, if we super cool this, we could actually sell it as a commodity around the world. Sharif Suki said, well, the U.S. is going to need all this energy, so let me build these import terminals. So when Sharif Suki was building this import terminal, something happened, and that was the shale revolution. Matt, do you want to take it from here?
Sure, that's a good opportunity to trade off and on. So for those of the people that haven't realized, obviously, we are not importing LNG, and I think the main reason is the early 2000s we underwent some sort of thing called the shale revolution, where basically we were doing one of two things, or maybe both. And these aren't new to the industry, but they were really combined together. These new technologies that we're kind of using to extract so much gas and being able to now be an exporter rather than importer was drilling horizontal wells, which that's not new. And then also hydraulically fracturing wells. So what that is basically you're increasing the pressure so much that you're able to crack the rocks open and fracture them, and then put proppants or sands into that lower quality rock to basically prop it open and allow yourself to get more surface area connectivity to the bigger reservoir that might be there. Otherwise, you might not be able to get the flow. So what they ended up doing was not only just hydraulically fracturing, but also turning the drill bit sideways by, sometimes it was initially 2,500 feet, then it was 5,000 feet. Now we're up to 15,000 feet, what they call 3XL sort of wells. Generally speaking, why they call it 3XL, generally a lease on land is about a mile by a mile.
I'm sorry, sir. Can you share my screen? This way we can.
So if you're going three leases, you're going 15,000 feet across. And so what that has allowed us to do is, kind of as Chris showed us here, gets you more connectivity to that rock. So things that may have been previously uneconomic or unable to be drilled due to the high cost, you're not going to get the flow rate out of it or whatever. If you just think if you drill vertically through that, you're not going to have a lot of surface area connected to that entire rich gas shale that you have there. If you drill horizontally, you fracture the well, you're going to increase the amount that you're able to be able to flow out. And so that led to the fact that initially people were like, we have a bunch of gas, but we can't drill it. It's too expensive for us to drill. We'll just import it. Well, we figured out a way, turned the drill bit sideways, hydraulically frac, multiple stages, 15,000 feet long horizontals. Next thing you know, as the world kind of puts it, we are now the largest natural gas holder, maybe other than Russia, in the world. And we are now the largest LNG exporter, then followed by Australia, Qatar. The people that Chris was kind of noting were the ones that actually were trying to get us to import a lot, as well as Australia. So the United States started much later than everybody else in this particular game. And we have, through innovation and through capital investment in our infrastructure, have now become the largest LNG exporter for probably the last 4 or 5 years, and will continue to be the largest LNG exporter. You guys can see in the upper right hand the Appalachia Basin where the Marcellus is. That's where I initially got my starts up at Penn State. We were learning a lot about the Appalachian Basin. A few of the people that actually started to recognize the amounts of TCF, my geologist professor basically was on the phone with some of these oil and gas folks and saying, well, if we were to actually start to do some of these things nationwide, and he was like, yeah, you'd probably be able to have 500 TCF of gas. And for those of you that don't know, generally speaking, when we talk about daily production in the United States, we talk about BCFs of gas. So when you talk about TCFs of gas, that's stuff that, you have around the world that people might be like, oh, 1 or 2 TCF, that's developable. Well, 500 TCF, as you can see, it's a pretty large chunk. It goes all the way into West Virginia. It goes all the way into to Ohio, Pennsylvania, all the way up into New York as well. And so that kind of, along with the Haynesville and many other places, which we'll talk about the Eagle Ford, the Permian, and a few other places here tonight, obviously unlocked a crap ton of gas. And so that's why you've seen pipeline companies across the U.S. Be in such high demand and so controversial, like the Keystone XL pipeline, although that one was mostly oil. But even still, if you think about it, the pipeline industry has made a massive killing. Kinder Morgan, Energy Transfer, a lot of these guys, because they went from basically producing local gas to people, and you obviously only are subjecting yourself to local demand, to now focusing on exporting. So the amount of capacity that you're having to, say, move in either direction has now increased substantially. And then also coupled with that, we didn't really think that we would need so much natural gas movement across the nation. We were mostly focused on coal. And then in the early 2000s, we realized we have so much gas under our feet, then here we go. And so with
Now,
that,
I'm going to pause
I'll
for
hand it
just
back
a
to
second.
Mr. Patel.
So I'm going to pause there for a second. If you take a look at this, this was natural gas prices in the United States prior to the shale revolution. So you can see here in the 2000s, sometimes there would be huge spikes and downward movements when there were really cold winters, because we were basically importing a lot of natural gas and using different sources of heat fuels. But once we discovered that we were sitting on all this natural gas, the price of natural gas dropped significantly. The reason why natural gas is known as the widowmaker is because there are times, because of geopolitical issues and weather related issues, that things can get really, really volatile. So as an example, in the March, or actually like February and March of 2016, natural gas in the United States dropped all the way to $1.6 per MMBTU. Okay. And then within 12 months had jumped up to 330. Now, that's a 3x increase in price. Then there were times where it spiked almost to 3 something again, and then it came back down again. So when it comes to natural gas is very, very volatile, not only in utilizing it, but also in the pricing of it. A lot of this is because of supply and demand changes, but then also companies that go in and out of production. So what happens is you have all this capital commitment that you have to invest in to drill. And then once you drill, the price of natural gas collapses, but your bills are due. So now all of a sudden you're in a bad position and you declare bankruptcy. And if you declare bankruptcy, you go away. So a good example of this was a guy named Aubrey McClendon. Okay. Aubrey McClendon was this gentleman right here, one of the smartest and most generous people in Oklahoma. This guy pretty much built certain parts of I think, what was it? Which university?
Chesapeake.
Duke. Duke.
Okay. I thought
He
you were
gave
talking
a
about
lot
the
of money.
company.
But the company that he founded, I think he was the founder of it. Yeah, was Chesapeake Energy. Unfortunately for him, he invested a lot of money into natural gas drilling, and then the bottom fell out, and basically Chesapeake eventually went bankrupt. I think they went bankrupt, or they reorganized, or bankrupt.
Yeah, they're bankrupt, and they're back. But yeah, they entered Chapter 11, maybe twice.
Yeah. And basically, he actually committed suicide by driving himself into a wall. So when it comes to natural gas, when it comes to oil and energy, just know that there are times where people feast and there are times where people famine. And if you are on the wrong side of that trade, you can go homeless. So, if that kind of risk is not your forte, then avoid the commodity sector at all cost. Do not think that you're going to be able to survive the ups and downs. It's really, really hard to figure out how to make money in this. But if you can, there's a fuck ton of money to be made.
Yeah, there's a lot of money to be made. But Chris, and I want to give everyone kind of a thought process. If it's a high level, when you're talking about commodities like oil, gas, gold, etc., they're very cyclical businesses. And so like Chris is talking about, you saw that feast famine of the price and commodities curve for natural gas. And it's exacerbated by the fact that it's hard to store gas versus storing oil. Oil is very much just a liquid. You can move it from tank to tank. It's not a very difficult thing to do. But gas, you have to have much tighter restrictions for your tanks. They have to be pretty much, very much contained. Versus oil makes it a little bit easier because it's liquids. So in that respect, it's very much when you have high local demand, your prices are going to skyrocket. When you have very low local demand, too much supply, that's when you have that feast or famine sort of movement. And so what we've experienced now, Chris, I don't know if you have the opportunity to, but if you pull up like the Dutch TTF or the Japanese LNG prices, it's like the United States has been very blessed. And if you think your energy prices are high, consider yourself graced, because you have no idea what energy prices are like in Europe and in a lot of the world. But if you think about where we are with respect to how plentiful we have in terms of natural gas, I'll hand it back to Chris to kind of give you an idea as to what I'm trying to refer to.
So what we saw there and on the screen before was our prices that moved between $1, $2, sometimes $5 and $6, which is a 600% difference. Well, in Europe, they experienced something that was on another level of catastrophic. In 2022, you got Ukraine invading, Russia invading Ukraine. Russia was the largest supplier of natural gas to Europe. And what happened? It spiked prices in Europe. So at one point, the price in Europe for on a British BTU level, in the United States, we had it for $2.56. The Europeans were paying $6.13 per MMBTU. After the Russia-Ukraine war started, that jumped up where now the Europeans at the peak were paying $70 per MMBTU. We were paying about 8.79, but the Europeans were paying almost $70.
The reason why we're paying 8.79 is because nobody wanted to sell it locally. They just wanted to ship it to Europe. So obviously it skyrocketed internally in the US.
This right here was an opportunity for some people, and we're going to discuss those people soon. Before that, we're going to go back to Sharif Suki for a second, because I think it's important to just show the company that he founded and what kind of returns you could have possibly got if you invested at the right time. So Sharif Suki, around this time, around the 1994s or whatever, he had started Cheniere Energy. 1996, he founded it. He basically almost went bankrupt a couple of times. Shale revolution comes along in the 2010s, and he ends up changing from import to export at the right time. What happens? The stock price goes from $2.96 all the way to $70. That is a 35 times return, not 35%, 35 times return. Okay. Then you had, of course, what we just described before, feast and famines within the natural gas space. Now that went down to $34. Okay. Now here's the funny thing. During this entire period right here, there was no exporting. Okay. Suki was not exporting. The first cargo that was exported from Cheniere did not get exported until what year was it that actually they started exporting? Let's see. First export date. Right here, 2016. Okay. People who knew this was going to happen, they had put in money early, but they did not see a single dime. And then all of a sudden, after 2016, they start exporting gas. And once they start exporting gas, their revenues start to just go parabolic. Crazy. And it's very, very profitable too. So if you look right here, that's their stock. But let me look at their income. Damn it,
But keep in mind, they have literally billions upon billions of dollars of debt, no income coming in at this point. And so when you're thinking about it, they hadn't necessarily gotten the entirety of the facilities online. So they might have cracked and been able to get LNG started to be exported in 2016. But at that point, they hadn't necessarily had all the facilities online. So you're still talking about massive amounts of infrastructure investment without the ability to have all that revenue coming in yet. And so, Chris, I'm sure we'll show you how the revenue has changed over time.
So this is their first cargoes. 2016, you can see this ramp up right here, $2.4 million. This is on a 12-month trailing basis. It slowly started to go up 7, 8, 9. And then we saw that spike because they had spot prices on their cargo. It spiked up almost to $33 billion of revenue that they were able to generate at the time. Now, why is this spike? Because of the spot cargoes that they had. But one of the things that we're going to analyze now is the business model. Now, these LNG terminals are not cheap. All right, they are very, very expensive. So let me just show you guys what one looks like. I think Ellen, let's look at Cheniere's, one of,
Type in Sabine Pass or
okay, yeah, that's true.
Corpus
Sabine
Christi.
Pass. Okay, yeah. So this is what a natural gas terminal looks like. Sorry. Are you guys seeing the screen or no?
Yeah,
What are
yeah.
you? Okay. This is Sabine Pass. Okay. Right here. So you see all of this stuff. Natural gas comes to Sabine Pass. It gets liquefied. It gets stored in these storage tanks, and then ships like this one right here. They come to the port, and basically they fill it up with liquefied natural gas. This ship is then transported to Europe or to Asia, different parts of sometimes even Africa and South America if they need it and they don't have it. And basically they utilize that to produce, electricity or whatever. So this thing right here is a gigantic project. These things range in the tens, if not 20s and 30s of billions of dollars. Okay. Now, the problem is we just said that the whole industry is very volatile. Banks do not like volatility. Okay, they hate volatility. Why? Because you don't want to lend someone $20 billion and then they say, hey, listen, sorry, things didn't work out. So one of the things that you have to do is you have to get agreements from third parties who actually do the selling of the natural gas. Maybe you can take it from here, Matt, because you have a little bit more experience in that.
Yeah, so I'm not that well experienced on the integrated shipping part, but what I can say is what you can basically sign up for is what they call SPAs, so sales purchase agreements, that basically you have originators in the trading floors that basically work with people in Japan, they work with people in Houston, and they say, we will be picking up from, let's say, Cheniere in Sabine Pass for 20 years and selling that to a bunch of different people, right? Whether they sell part of it to South Korea, Japan, the Dutch and the TTF market. It really all just depends on who's asking and who wants it and who needs it. But basically, it affirms that you have a customer and they will be grabbing gas from you. And with that, you can basically use it almost as currency to be like, look, we are guaranteed revenues that will be paying off this train for at least this much of this. And so this is very important because what we're talking about is one of the key differences which will make Venture Global and Cheniere maybe not necessarily analogs like people might think. So just keep this piece that's very important. Now, people can, I think, sell up to 85 to 90%. And basically, you need that to be able to be affirmed by the banks. Now, what some people might do is they might sell up to 100% of the capacity of their trains to basically to say, you know what, we're just going to be 100% based off of the cash flow that we get. And that basically is allowing you to have a operating costs for fixed costs. You might have an estimate as to what your fixed costs are. It might be $2 to $4 per MMBTU. And then with that, you'll likely also try to charge a little bit of upside with respect to the Henry Hub prices that you're selling. It's generally pretty standard from what I've seen to sell or to get about 15% of whatever the above the Henry Hub price is. So basically you're getting the Henry Hub price, putting a 15% multiplier on top of that, capturing that little 15% plus whatever your ops costs are. And with that, then that contract, whether it's from Total or Shell or Abu Dhabi National Oil Company, will pick that up from you. And then they'll be able to say, hey, we were able to pick this up at $6, $7 an MCF. And now we're able to go to Japan or to Europe in the case that Chris has showed in the middle of 2021, 2022, was selling for north of $50, to basically get it over there. So then you have these companies that are making this margin. Well, it's beneficial on both sides, right? Cheniere is able to make that that little bit of margin between buying it at $3 an MCF and being able to sell it at $6 or $7 an MCF. And of course, they have operations costs within there, but they are making a decent amount of operating profit associated with doing that. And then you also have the integrated shipping piece where, of course, yes, they buy it from Cheniere at the $7 or $8 range, but then they're able to go and sell it to Europe or whomever for $50. Now, of course, there's the fact that you have gasification of everything that actually is in the tanks, and you use that for fuel and what have you. So you do have some losses, but your margins going from $7 to 13, or in the case of 2021, $7 all the way to $50 an MMBTU, like we saw back in 2021, 2022, is very important for what we're going to talk about with Venture Global. And not only that, but it's also very important with respect to how some of these LNG trains are set up. And even if we talk about a little bit about next decade as well, it's also very important because next decade is very much funded like Sabine Pass was for Cheniere, where they have about 92% of the capacity basically contracted. And it leaves 8% for you to do whatever you want with. If you want to trade it yourself or have somebody sell it to somebody else at a different price, which might make it more beneficial for you, depending upon how the local markets look like. But that could be positive or negative, right? That 8% could be awful or it could be great. It really just depends upon what you've negotiated. Keep in mind the fact that you've already pre-negotiated, hopefully with inflation and hopefully with good faith, the costs that it takes you to run the facility, plus your overhead that you want to charge this individual contract, plus the 15% above Henry Hub. And so that's kind of a very clean generation of cash flow that you can very much look at and say, hey, we have 50 MTPA, metric tons per annum, and we're going to sell that all at a certain cash flow, and we're going to make that money. Versus if you have the spot prices, it could be $10 one day, $2 the next.
So just to basically give you guys an analogy to make it understand a little bit easier, imagine right now you want to start a lawn mowing business, but you need a loan to the bank, right? You need to buy a truck, you need to buy lawn mowers, you need to buy like safety gear, all that stuff. If you go to the bank and say, hey, listen, I want to start a lawn mowing business, lend me money. The bank is going to say, well, I don't really know you, which, why should I lend you this money? But imagine right now you went to a neighborhood and you had 20 people and they say, yeah, every week, just come by and we'll basically give you $100 to mow our lawn, right? And now you have 20, 30, let's say 200 people. You have these people that give you this piece of paper that says, I guarantee to basically let this person mow my lawn for the next 5 years and give him $100 a week to do it. You take all those pieces of paper, you go to the bank and you say, look, if you lend me the money, I have the customers that will basically let me pay you guys this money back in a certain period of time, right? So the bank says, oh, look, you actually have clients already. You have a business together. Let me go ahead and lend you this money. If you just go there empty-handed, no one's going to give you the money. But if you have customers, and especially if those customers are well-known customers to the bank is going to feel a lot more comfortable lending you that money. So you as the entrepreneur will get that loan. You'll go and buy this equipment and you'll start cutting people's lawn. You'll start paying the mortgage. You start paying the bank back, but you're also going to be generating some profit from that, right? Now, the thing is, the bank lent you that money thinking that, hey, this guy has the capacity to do, let's say, 200 homes, and this is how much cash flow he's going to generate. So I'm going to lend him this much money based on that cash flow. But let's say you could actually do 250. And the additional 50 that you do, you're doing freelance. Maybe some people need emergency lawn cutting services and you charge them $200, or $300. You go and say you want to do other things with it. So that is where you can make extra money. So a lot of these natural gas companies, the liquefied natural gas companies, they'll do, like Matt said, up to a significant portion of their capacity, but they'll leave a very small capacity amount just in case that they have like these spikes here and there with natural gas. And sometimes that really pays off during years where there's a huge demand spike. Now, one of the things that you can do after you start making money is maybe you're really good at this and you're said to yourself, hey, listen, I could probably buy 5 more lawnmowers and do another 800 houses. And I could use my existing cash flows to basically pay for all that additional equipment. So that's what some natural gas companies did. So if you look at Cheniere, that's what they did. Cheniere said, look, we're generating money. from selling all this natural gas. But then we're going to build a second terminal. And so that's what they're doing. They're building another terminal that basically expands their ability to export more liquefied natural gas. Now, of course, some of it is being financed by their own cash flows. But once again, it's very, very expensive to do that. Now that you actually have a track record of developing natural gas terminals, counterparties will come to you and they'll say, hey, listen, you're a pretty good supplier. You're always consistent with giving us the gas. You live up to your contracts. So we will contract your next project. We'll work with you and get the next contract going. So Cheniere says, give me those pieces of paper, goes back to the bank and says, look, I've got more capacity now. Give me more money so I can build a second terminal. And this is the one area where Venture Global took a risk. I'm going to explain that risk. And once you get it, you'll understand what happened with Total. Any things you want to talk about, Matt, in between that?
No, I think that's well said. I think that one thing that Chris said, but I think I just want to kind of like reiterate in a slightly different way, is if you think about it, if you're kind of at the mercy of the banks and you're kind of at the mercy of the other folks that come to the table and basically finance your deal, you're not going to make as much money. I mean, let's just be truthful about it. You have to kind of say, make it a win-win agreement for both. And so when it comes to like what happened with Cheniere and what happened with Next Decade and also what happened with Venture Global, you have to think those initial contracts probably aren't the most favorable. They work for both sides, but they're not necessarily going to be barn burner deals, right? They're not going to be the best deals for, say, Cheniere, and they're not going to be the best deals for Venture Global. It's going to pay the bills. It's going to show up very well. And of course, you have Cheniere buying back stock, and they're increasing their revenues, and everything's fine. But at the end of the day, it's like it's a win-win for both. It's not a very imbalanced win for one party or the other. And so I'll hand it back to Chris because he'll kind of explain how what Venture's doing might be more of a win specifically for them.
So Venture Global is a little bit different in that they basically went to a bunch of people and said, hey, listen, we can do this LNG thing for you. And they had partners, and they had really good partners. They had BP, they had Shell, they had Repsol. These are big, large, multinational liquefied natural gas traders, right? They utilized that to get a nice big fat loan from the banks. They started building their terminals. But unlike how Cheniere did it, where they built those terminals, these guys did a more modular design. And what that allowed them to do was generate natural gas at a much faster pace. So basically, they were able to liquefy, and they were able to compress their timeline significantly. Let me just bring up their S1 because they highlight this as a investing standpoint. Let's see.
So the trains are much smaller, right? They're able to be factory made. They're more medium-sized trains. So they're about 0.75 to 1 MTPA per train versus like Cheniere, most of those trains are 5, maybe even slightly larger MTPA per train. And so it allows you to install them on a more modular design, like Chris said. So you might be able to connect up a couple of them at a time, get them up and running while you're commissioning the rest of the stuff. And Chris, I'm sure, will iterate more on that.
Yeah, I'm going through the entire S1. I should have had this like slide ready to go. But typically the construction timeline that it takes to get natural gas going is usually about would say like 5 to 7 years, depending on here it is. I found it. Okay. So from start to finish, this is a big differentiator for Venture Global. So if you look here, the timeline, Shell LNG Canada, the FID was in October of 2018, still hasn't started producing. Qatar Energy's Golden Pass, which is here in the United States, it's 6 years in, still working on it, okay, since the FID. If you look at Venture Global, they did it in 2.5 years, 2.4 and then 2.6 years. which is kind of crazy if you think about the amount of time that it took to get from FID to this. Now, if you look at some other companies like Next Decade, they're under construction right now, but they're dealing with a lot of regulatory hurdles, and a lot of times these construction projects are not just delayed by like weather and supply of inventories and all that stuff, but also from a regulatory standpoint. If you get an administration that's anti-energy, you could end up seeing yourself get bogged down in the courts. Venture Global, luckily, did not get bogged down. They had everything FID'd and they started the construction. Now there's one problem. They ended up starting to generate money, and they started to, what is that thing called?
Commission.
Well, see, this is where it gets a little tricky.
It's not tricky.
I mean, okay. So
depending on what side you're on, it's not tricky.
Okay. So they had these customers lined up, ready to go to buy liquefied natural gas. They're about to get done with construction. And the Ukraine war happens, right? Price of natural gas skyrocket. So now all these companies like BP, Shell, Repsol, everyone's like, oh, thank God. We had all these contracts for cargoes already. We're good. Like, we're going to get this energy. We're going to sell it at a shit ton in freaking profit, and we're going to be making money. Well, Venture Global says, listen, our deal was when we are finally commissioned, we'll sell it to you guys. All the while, they were selling natural gas, saying that technically we're not done with it. So we can sell it at the spot prices because it's called commissioning inventory. So imagine right now you're building a house, you're building a subdivision, and you've sold all the houses in the subdivision, but you're not allowed to take occupancy until all the houses are done, right? Because the subdivision is still under construction. What if that company said, you know what, I'm going to go and let people rent because, there's a housing shortage, let people rent out those homes for 5 times the market value or 10 times the market value. So that's what Venture Global did. They basically went out there and sold cargoes in the spot market and made an absolute killing. But what did that do? That screwed over BP, that screwed over Shell, that screwed over Repsol. And they were like, you were supposed to give us those cargoes and we were supposed to sell it, not you. And that's where the problem started, because now you've basically created counterparty risk. You told everyone you're going to do this by a contract, and you use loopholes within that contract to basically not sell to them and instead sell into the open market, and you made a killing. And this is where BP, Shell, Repsol, all these companies are going to these guys and saying, you guys are untrustworthy. We're goddamn suing you. And right now the whole thing is in arbitration, where basically, a judge has to determine, an independent judge has to determine if Venture Global was within their rights to sell on the open market, or whether Shell, BP, and all of these guys were correct in basically, asking for their cargoes to be filled so that they could, make money. So
now I want to give some finer detail on this, because people might be one-sided and say, oh my God, Venture Global, evil company. But, depending on how you read this, it's reason why it's going to court. It's not very cut and dry, right? So there's labels within that. Of course, yes, you can commission whatever you have. And keep in mind, the way that Venture Global does this is they have very modular trains. So within here, they have 18 trains at this first Calcasieu Pass LNG facility. So what they could do is get 4 or 5 of those, 6 of those trains, because 2 of those trains connect up in one, right? So it's kind of like a mini train that connects up and ends up being one. So one of those sets, 2 trains, one of those sets ends up making about 1.5 to 2 MTPA per annum. And so what you can do is, if you set up your facility right and get everything in order, as soon as those trains come out of the factory, you can set them up. Now, technically, where Venture Global is saying is until that 18th train that they had sanctioned with the project is there and commissioned and up to nameplate capacity and fully functioning and has been certified by the regulator to say, yep, you guys are at nameplate capacity, you guys are up and running in commercial, all 18 that we have agreed that you can utilize to be able to export your 10 MTPA as instructed, then technically they believe they're still in the commissioning phase. So depending on what side you're on, if they only have 4 out of those 18 trains or 10 out of those 18 trains, or let's just say up until a couple months ago, they were only at, say, 16 out of those 18 trains, technically they're not at a place where they're fully commercial to the point where they stated that this is what our contract is, and we will go from 18 trains fully commissioned forward and give you guys that gas. Now, whether or not they slowed down, whether or not I don't have that knowledge, I'm not privy to that knowledge, but at least this is what they've explained as the reason why. Now, keep in mind, it allows you to get gas on much sooner the way that they're doing this. Obviously, we saw 6 years for a lot of these other companies for major projects that are ongoing versus the 2.5 years that we've seen for Venture Global. So are you really in the wrong here? Because you're still, even after a 2-year commissioning window, 2 years ahead of what a normal LNG project would be. So in this particular case, I mean, who's really wrong? I mean, if you look at what's going on with NEXT, that's going to take until 2027. They started building that in what, 2022, 2023 timeframe. So it's like that's going to take a long time before you actually get those cargoes to start going out and up. So it's just an interesting piece. Yeah, I'm interested to see how this looks.
Yeah. So I'm going to show you this real quick. So if you look at other projects, there's no definite like exact date that this thing is supposed to start, right? It's hard to really estimate because construction overruns, regulatory stuff. So usually the deals are, hey, we need to be fully commissioned in order to sell to you guys. And so that's technically the loophole. So if you look at some of the other exporters, look at how long it took them to get to first ship cargo. These guys were able to do it very quickly, which is a great thing for them. But at the same time, it basically lets these other companies feel like, you know, they got shortchanged on this whole thing. Let me just basically show you guys one thing. So one of the things with Venture Global right now, because of this whole arbitration thing, that's an overhang for them. But they were able to make so much money during that whole episode where they were selling cargoes that they were able to pay off a lot of money in their debt. So you can see here in 2022, they generated almost 6.5 billion in revenue, and they got an income of about 3.5 billion in income from that. So it's like, you know, once if you're in some good times, you're in some good times. Now the total capacity here for and this is where maybe we can talk about some of the opportunities that are here for Venture Global. Venture Global, okay, so here it is. You can see here that depending on which project you're looking at, there's a huge upward swing in production that's going to be coming online here in the US. This was the existing exporting, but then you had Plaquemines, which is them, Rio Grande LNG, which is next decade, which is still under construction, Golden Pass, Port Arthur, Corpus Christi. A lot of these have been basically put on some sort of a hold because of regulatory issues. Like next decade is still dealing with that. It's not fully clear when they're going to actually start and all that stuff. But there's a high concentration of projects that are currently either under construction or coming online in this particular region. Let me just, where was this damn thing? Okay, this right here. This is important. Sorry about that. So if you look at the expected capacity for these projects right now, if you look at this one, which is stages and commissioning, Calcasieu is, I think, fully commissioned now, which means they're ready to actually ship to their counterparties. So even though Shell, Repsol, and some of these other BP quote unquote got ripped off, they are still going to be buying LNG from these guys. Okay, it's not like they're saying, okay, we're ending our partnership with you and we're canceling all of our contracts because you were dicks about it. All they're saying is, listen, you cheated us. We're gonna deal with it in court, but we're still your customer, which is good because that means that they'll still be able to get revenue and do all the other stuff. So they have a total of almost 6 projects in development, 2 which are one which is fully operational. Plaque Mines is the next one that's currently under construction and quote unquote commissioning. So that's up next. So if you see here, this is what the nameplate is in terms of capacity, but then there's like additional capacity that if they if they really ran their stuff hard, they could eke out more capacity and expand out. But the goal here is that unlike Cheniere, they have a lot of excess capacity that they plan on selling in the spot market. Okay. So they are taking a little bit more risk compared to Cheniere by saying Cheniere says, we'll just contract out majority of our expected capacity. Whereas these guys are like, we're going to hold on to more of that capacity to ourselves, and we're actually going to sell it ourselves. But they still need counterparties. If you're trying to develop these additional projects, Venture Global has money and they have cash flows that are going to be coming in for the next, in the next few years, but it's not nearly enough to develop all of these other projects that they, kind of want to have. Now, if you look at one of the statements that they have in their right here, one of their goals, substantial ownership and direct oversight of diversified project portfolio. Venture Global seeks to own all or substantially all of the equity ownership in its current 5 LNG projects and any future projects. As of this date, we own 100% of the common equity interest in Calcasieu, Plaque Mine, CP2, CP3, and Delta. Upon I think certificate of development, I don't know, COD of Calcasieu.
Commercial online date.
Commercial online date. Yeah. We expect our ownership of the commodity common equity interest in Calcasieu to be reduced to 77%, assuming that we service all future distributions. They have like a deal with their equity preferred equity holders that's a little bit different. But if you look at this is one really, really big differentiator compared to something like NEXT. NEXT, what they do is they don't just sell the capacity, they also sell equity ownership in their projects to third parties. So it's almost like you're bringing that third party closer to you. And instead of them just being, buyers of yours, they're actually part owners, right? So everyone is happy doing that. Now, here's the thing. It relieves certain burdens on Next Decade's company because now you don't have to finance everything yourself. You've got these giant partners who are willing to throw money at this project with you, right? Venture Global is like, we don't want partners. We want customers. We want this equity, all of this profit to go to us, okay? Now, because of that, they're a little bit ruthless on how they did their whole thing with 2022. Okay. They could have at the time said, you know what, here, we'll share some of the revenue. We'll do some stuff with you. Maybe in the future, we'll sell some equity to you guys so that this way we both benefit. They're like, no, we're not doing that. We're keeping all the equity. If you want to be our customers, that's one thing, but we're not giving away equity. Now, why is this benefit shareholders? Because you're getting all the cash flows. All the cash flows come to you, okay? Next Decade, they only own a certain capacity of their future cash flows. So one of the big differentiators when you're looking at something like Next Decade versus something like this is that you're getting all the future revenues. You're not getting a partial revenue. Now,
the beauty is you look at that beautiful table and you're like, okay, you don't have to get a calculator out. You don't have to. You literally see it's like, okay, you get 100 MTPA on the nameplate plus 143 for excess capacity. You start talking about Next Decade, you're like, okay, let me get a pen and paper. So they own 20% of trains 1 through 3, which is 17. You know what I mean? Like it gets more complex and it's a lot harder to value in that respect.
Yeah. So Now, so, Venture Global has basically just gone public, and they go out there and they're trying to sell additional capacity so that they can get more of these notes, so they can go to their banks, get more money, so they can use that money to build more of these terminals. Total says, nah, we're good. We don't want to work with y'all. And that's the news that came out today.
No, the news that came out was basically, I think, what it ended up being, which I think is more gossip than news at all. Which is they basically said, oh, they offered if we wanted to do anything with Calcasieu Pass, and they offered if we wanted to do anything with Plaquemine, and they basically said no. But both of those projects are online.
Yeah,
both of those projects are already commissioned. So he's talking about stuff in the past. So to me, it's like almost like he's just gossiping because he wants to, I guess, add fuel to the fire because of what happened with Shell and some of the other counterparties. So to me, I think it's a little bit interesting, but I don't know if I'm going to steal this from you, Chris. So calm me down if I jump ahead too much. But I think the problem with what we're dealing with here is you now have Cheniere, which is valued at over $40 billion and between $40 to $50 billion. And it's 50 MTPA online at the moment. We'll soon have 60 MTPA online within the coming months or years. And they also have another 5 or 10 or 15 MTPA that they're going to expand at Sabine Pass as well, for a total of 75 MTPA, with 50 right now currently shipping, all on spots, right? All on sales purchase agreements, majority of it, right? Then you have Venture Global. So Venture Global has technically not yet hit a commercial online date with the Calcasieu Pass facility that started commissioning in 2022. And they just started commissioning and actually had their first commission sail away in December, almost late December 2024. So literally within the past month and a half. And so with that, it's hard because all the revenues we've seen from the S1 for Venture Global and everything like is strictly from that first facility. We haven't seen any profit or revenues coming from that second facility. And so everything that you're doing is currently talking about all this debt, all this future, capital expenditure, and everything like, without the second facility. Keep in mind, the second facility is actually twice as large as that initial first facility. And so what we've actually seen to date from 2022 till now is over $12.5 billion paid down of debt that initially Venture Global had on the balance sheet. But basically they were able to get these cargoes, these commissioning cargoes, get the revenue from that and pay down $5 billion in 2022, $5 billion in 2023. And I think it's going to be $2.5 billion in 2024. I guess we'll find out in the fourth quarter earnings. But here you have, as people are sitting there like, man, they have $23 billion worth of debt and they're only making this much net income. But keeping in mind, like, they haven't gotten the second facility on yet. So when you start to look at these metrics, the debt to equity, the debt to, not debt to equity, the debt to EBITDA, all these sorts of things are going to drop drastically when we not necessarily look at the fourth quarter earnings, because they only had one sale out of the second facility in the fourth quarter. But once we get into the first, second, and third quarter of this year, we'll really start to see the true potential of that second facility coming online. And then you have the potential of these 3 additional facilities that have yet to be FID'd. And there's an important part to that, which Chris has kind of started to allude to, which is at the moment, not all of them have actual spot contracts, the things that you need to go to the bank to get financing for. Why don't they have that? I don't want to spoil it, so I'll take a pause because it'll take a little bit, and Chris wants to chime in with this. So I'll take a pause, and maybe we'll get to that a little bit later.
Okay. So, sorry. I thought I had a little bit more time to finish chewing my ice, but
Damn it, Chris. No, I was kidding.
So, of course, Total said their thing, but one comment that is very, very interesting is this last thing. He said, however, that Total is prepared to buy Venture Global's spot cargoes if they become cheap enough. Okay. Now, here's the thing.
Gossip, man. All gossip.
When it comes to energy, it's a ruthless business. Okay. It's very ruthless. But the one thing that I'm always reminded when it comes to oil and natural gas is the only thing that walks is money. Money walks. What is it? Money talks. Something walks. I don't know whatever the saying is, but basically, they're trying to use this as a leverage point to get as low of a price as they can on that spa deals that they have. Venture Global, of course, is going to have to figure out how to sell their spa deals. I don't think that there's any sort of shortage with the amount of counterparties that are going to be looking to sign these spa deals anyway. I think a lot of this is just rumors, and that's where the real opportunity is. Total is not the only game in town. There's a ton of national oil and gas companies that are willing to buy, including ones from China, including from Japan, South Korea. There's some independent ones like Gunvor. India is another big one. So the demand for LNG is really, really high. So I don't think that there's going to be a lot of counterparty risk here. The one thing that I'll just say about this whole thing is you're going to deal with geopolitical things that come along. You've got wars. All of a sudden, now you've got 15% tariffs from China because as a tit for tat, because the U.S., one of the Trump administration's main goals for the next 4 years is drill, baby, drill. Now, here's the thing. What they actually should say is export, baby, export. One of the things that we have is a massive trade deficit with the Europeans and around the world. The Trump administration wants to basically set it up where it's like you need to buy more liquefied natural gas from us and not the Russians. And the Trump administration is really going to put that pressure on a lot of these countries to do that. And when that happens, the spa deals will, of course, work out well, and these guys will make money. So my perspective is Venture Global is a great company to buy. Just understand that there are risks. But I think right now we're getting excellent pricing on it. Maybe we're a little bit early. Maybe we could even get this at under 15. I can't really say. But, in the grand scheme of things, my objective is in the next 5 years, this is going to be above $100-something, based on my calculations. Now, the calculations that we have and all that stuff, me and Matt will probably keep that to ourselves and our Patreon people because they support us. They keep us in the black somewhat. And so there is real opportunity here for people that are willing to take the risk, willing to wait and be patient on this whole thing. So, yeah.
Yeah, I can easily, I can see a place where not only do you get the initial bump up in the share price, but also in the long term, share buybacks, distributions, things of the like. And what I would like to say is I've seen a lot of people wanting to get involved. I've seen a lot of people get emotional today based on the fact that the prices retraced. And I thought I was pretty clear about this, and hopefully, everyone's been thinking about this. This is something that's called an investment, right? It's early. The IPO was already richly valued when they first came in. It was still richly valued, in my opinion. But at the same time, where this company is going, it's definitely going to be something that you have to wait around for 5 to 10 years before you actually see the fruits of your labor. So if anybody's looking for a trade, this is not the company for you. There's going to be volatility associated with it. There's going to be the counterparty discussions and not liability, but I guess there is the liability of the counterparty discussions and many other hurdles that we have to get through. But you have to also recognize is it's very hard to value a company like this. We know long term this will be the premier LNG exporter on the United States. If all these facilities go through, they're going to FID the third facility, which would put them either at par or slightly above where Cheniere is. And then once you get to the fourth facility, it's done. Cheniere is, I don't want to say irrelevant. They'll still be the number 2 provider of LNG exporter in the United States, but comparatively, it'll be eclipsed by the fact that Venture Global will have much more installed capacity than them, But I think what people need to recognize is, how do you value this company right now? And Chris alluded to it. I don't necessarily think it's an excellent price here. I think that this is something that you're still maybe paying a little bit over for. But at the end of the day, like we said, it's hard to value this company because the revenues that you're seeing on the screen from S1s, you're going to start to run discounted cash flow numbers, etc., based off of that. Well, that's all about to change because it's about to hit commercial online date. You're going to get different sorts of sales and revenues than you were over the past 2 years. And then coupled with the fact that you have the second facility online now. So how do you value that second facility, and what kind of revenues are going to be coming from that, and what debt pay down is going to be coming from that, etc. And then once you get to the point where that just comes off and goes into commercial online date, which will be like early 2027 timeframe is what they're forecasting, then you're going to have this third facility right in the wings to potentially come online. But granted, if they hopefully get an FID here within the next 6 months or so, that's kind of the hope, mid-year 2025 to 3Q 2025. Within 2 years, 2.5 years, you should have that facility online. So by the end of 27, so you have to realize, like, it's going to be a combination of where do you think in terminal rate this company will be, and will they potentially buy other land? I was looking specifically around what other leases they have. There are other leases, as well as the Delta facility has the same size of capacity as is either Calcasieu Project 3 or number 2, where they have about 1,100 acres. And yet the facility is technically smaller than the other facilities. So why is that? Can they expand that facility? If that's the case, you have the opportunity to potentially go much further. And then, as Chris alluded to earlier, the first 2 facilities do have spas. That was necessary. Obviously, Venture Global, this is their first sort of projects that have ever come to fruition. So they needed those spas to be able to get the debt financing associated with it. But the third facility is only filled with half spa. So I think it's a 20 MTPA facility. There's currently only 9.25 MTPA contracted. So will they only go forward with only 50% of that facility contracted, or will they try to find the other folks to help contract it? And then the remaining 2 facilities, Calcasieu Project 3 and then the Delta Project, both have 0 at the moment. Now, keep in mind, during this whole time, which is also part of the reason why I think that these guys are able to get the projects online so quickly, is because they've already started to invest by themselves the EPC contracts, the engineering, procurement, and construction. They've gone out, they said, hey, we want you to start building this already before we get the trains sanctioned, before we get all that. So basically, you have everything initially set up, and they've already spent $3 to $4 billion worth of EPC on the third facility. So by the time they actually FID it, it's already in motion. It's already being engineered, procured. It's already being partly constructed. So by the time they actually get the trains on there, it's much shorter of a timeline versus the traditional way is you get an EPC evaluation, you get an EPC sort of contract in hand, engineering, procurement, construction contract in hand. And then once you FID, that's when you actually sign everything and make sure that everything kind of goes through. And so with that, these guys are able to turn things around much faster. And keep in mind, like Chris noted earlier, Cheniere, all of it is spas. All of it's contracted. You're only getting the small margin of what you're getting for your ops costs at which you sell onto the customer, plus 15% above Henry Hub. Venture Global, in this particular case, yes, the nameplate capacity, 95% of that is actually sold. So, but for example, maybe I could share this, and then I want to hear what Chris has to say because he pulled something up. But in my article that I wrote on Seeking Alpha, you can find, if any of you have Seeking Alpha, you can take an opportunity to look at that in the description. But let me zoom in a bit here. So these are the different projects. These are the projects that are operating and online. These are the pre-FID projects down here. Let's concentrate on up here. Of the nameplate capacity facilities that have been put online, you have 30 MTPA. That's huge. That's massive. Not many companies get beyond. In their entire portfolio, some of the super majors don't even have 30 MTPA in their entire portfolio, and they're contracting from all over the world: Qatar, Australia, Mozambique, anywhere, Trinidad, anywhere where they. And that's where I was helping to do is fill those LNG terminals in Trinidad. That's why I was down there living the dream. Send me back if anybody's listening from the office. So what I want to highlight here is the spot contracts. So you have a nameplate capacity of 10 MTPA for the Calcasieu, and for the first 3 years, you have 10 MTPA. So you have 8.5. That is 6 different contracts for 20-year spot for the entirety of the online date. Then you have a 3-year contract with Unipec for 1 MTPA, and then the Chinese National Oil Company is half an MTPA for 3 years as well. So not only do these guys have CODs, SPAs for the first 3 years at 100%, after 3 years, it drops down to 85% of nameplate. But then they also have another 2.5 MTPA that they think that they can optimize and debottleneck the facility to get it to be optimized by another 25% or so. And then same thing with what we have here for the second facility here, 20 MTPA, 100% initially. You have pretty much, this one's a little different, 20-year spot contracts for pretty much the entirety of the thing. But you have a small 0.3 MTPA for impacts here. But you still have an additional potentially 20% or slightly more, 25%, to be able to commission. So out of the first 3 years of these facilities, yes, you have 30 MTPA, but in reality, you have 39.6. So you almost have 25% of your entire capacity. If they get it debottlenecked, we'll sure hear about it once we start getting progress updates, because now the company's public. There's no investor presentations or anything like it at the moment, other than what you see in the S1. We'll hear more about how that's looking, what kind of commissioning or above, sorry, not commissioning, what above capacity sort of shipments they're getting. And that's where the lucrativeness of some of these projects show up. And then if you do want to lastly check this last thing down here, you have 20 MTPA, only 9.25 MTPA sanctioned at the moment for this. Are they going to fund it themselves? It's going to cost $27 billion per their thoughts. So interesting. But yes, hopefully by mid-25 they sanction it, and then end of commissioning will be or start of commission will be end of 27, and then the commercial online date will be 2029.
So someone was asking in the chat, when do they expect to start paying dividends? Not for a very, very long time. Every excess point of cash flow is going to be reinvested in developing these projects. In my estimation, while the Trump administration is still in charge, they're going to do everything in their power to push their construction timelines. Why? Because once you have this facility and it's already working, no one can come and mess with you. If, let's say, 2029 comes and all of a sudden now you get Democrats in the House and Democrats in the presidency and the Senate, they can throw some monkey wrenches in like the Biden administration did, and then you got problems. So they're going to try to move fast as possible, and that means that the additional cash flow is not going to be going towards shareholders. It's going to be towards basically building out the business. The one thing I'm going to show a couple of things that makes this a little bit different than the other projects is the EPC contracts that they have. They're basically managing their own construction. Okay, when you look at something like Cheniere, you look at Next Decade, they went out to a third-party company called Bechtel and said, "Hey guys, do all the procurement, do all the construction, do all the management, and you guys will take a fee for doing all that." These guys are like, "No, we're gonna do it ourselves. We know how to build our terminals. We did it successfully with Calcasieu and Plaquemines. We're gonna do it for everything else." So this is also technically saves money, but also keeps a very tight approach on timelines. When you have an EPC contractor, they're gonna do their best to stay within a certain time frame. But if you do it yourself, it's a little bit more, what's the word? More likely that you'll that you'll do things your way. So one of the great things is these guys have hired their own people. They have their own construction crews, and they're doing everything by themselves. So that's one big differentiator. They're not giving away excess construction margin. They're keeping all of that margin to themselves, and they're also keeping a very tight control over the construction portion of it. Another thing to also look at is this right here. Sorry, they
Well, Chris
own.
poses up. Why is LNG important? Right. I would just want to iterate this.
Yeah.
LNG, if you think about it, well, let's take natural gas, right? Natural gas, you can compress it, right? Gas, you can compress and pressurize, etc. If you liquefy something, the molecules, or at least the nature of it, will allow you to shrink it to 1/600th of its size. Otherwise, if we were to try to build pipelines or anything like that across the Atlantic, Pacific, it just wouldn't be economic. What is economic, though, is to hyper pressurize and super cool this stuff down to minus 270 degrees Fahrenheit, where it's super cool, and then pressurize it, put it in tanks to the point where it literally shrinks to 1/600th of its size. So when you regasify it, you now, at a normal standard cubic feet level, have 600 times the amount. Whereas before, you only had this little box of 1 square foot. Now you have 600 square feet of the same amount of gas that you can use to heat your homes, etc. So anyway, back to you, Chris.
One big differentiator is that they're also working on making sure that they have, damn it, man, they had like one really nice, what is it called? Like, all right, there it is. Found it, finally. No, don't go away. Go away. Come back. Okay. I'm sorry if it's too small. People can't read. If I zoom in, it goes away. So it's legible, right? Okay. They're also in the business of making sure that they're vertically integrated. Okay. So they are working on a pipeline. So they have pipeline infrastructure, and they have shipping. So they've actually have about 11 LNG tankers that they've pre-ordered, right? 2 of them, well, they ordered 9, they chartered 2. 2 of them have already been delivered to them, right? So this is where they're taking their own shipping. They're not they're not basically contracting with third parties in order to ship the natural gas that they have on the spot market. Why is this important? Well, if you look at LNG tanker rates, when prices go absolutely berserk, they have the same thing happen, which is right here. Let me just share my screen. Sorry. Okay, there we go. So whenever price of natural gas goes up, what can happen is the price at which you charter these boats can go up and down significantly. Okay, so if you look right here, when well, actually this is a bad example, LNG charter rates, historical. Okay, so let's do this. Maybe this will show it. Okay, damn it, everything's under a damn paywall these days, man. Okay, there we go. This is one that probably helps. So it's one thing to own the spot market where you can sell into the spot market, but you still need to have contracted ships that take the LNG to their final destination, right? The problem is usually when natural gas prices spike, the cost of transporting the gas goes up too, right? So if you're an LNG transporter, like you own the boats, look at what happens. The price per day goes up significantly. So these guys are saying, we're going to take the guesswork out of the mix, and we're going to own our own ships. So they ordered ships themselves. So they have their own LNG carriers that are going to be able to transport it. And this way, if there is a spike in shipping prices, they won't be impacted by it nearly as much as somebody else who's, basically buying and then trying to figure out who's the lowest cost shipper is. So you're getting kind of like this vertically integrated platform where you have pipelines, and then they also have, believe it or not, did you see the thing that they have? They have regasification plants in the UK.
And Europe, yeah.
So the challenge here is, how do you value a company that has all of this going for it? And it's really hard to do, because what happens is a lot of people are looking at, let's look at Cheniere, which is its next cousin over, and let's value it like Cheniere. And my thing is, let's not do that, because their business model is completely different. They're not trying to become an LNG exporter. Their goal is to become ExxonMobil, okay, where they own everything. They own the shipping, they own the terminals themselves, they own the pipelines, they own the regasification facilities on the other end. And so that is the value proposition for shareholders who buy in today, tomorrow, whenever. Because if they are successful, you're looking at the ExxonMobil of natural gas. And I don't know any other company in the space that has a similar potential,
Publicly traded? No.
Not publicly traded, definitely not.
Yeah.
The only person that I think is even a competitor to this is Qatar, like the national company of Qatar.
Yeah.
That's it.
They're
the only ones. They're the only ones with a similar thing. And believe it or not, they're going to have more capacity than Qatar will at one point.
Yes. No, they will. 100%. I think Qatar is trying to get to 80 MTPA. And so and they're the second largest, if not the third largest. I think Australia's up there. But Chris is right. I mean, you'll have international oil companies like Chevron and Shell and Exxon have some of these facilities around the world. But at the scale that these guys are building it at Cheniere, and then even at the scale that these guys are trying to integrate at Venture Global, which is taking another step beyond what Cheniere is doing, and then also having the IST, integrated shipping and trading business, is, in my opinion, second to none. And I think that that's part of the reason why, even though it might go down further from here, you at least should dip your toes if you have the opportunity and appetite for a 5 to 10 year time horizon. As it showed, you've seen how these guys have been able to get their facilities on quickly. Now, let me just share briefly. I know this is a bunch of numbers, but these are from the S1 when I wrote my article, basically trying to capture what exactly went through. So keep in mind, this is one facility for all of this, right? And this is still trailing 12 months of September. So it doesn't have the full year earnings in here as of yet. Sorry, just jumped around for a second. Let me hide this. You have revenue anywhere between 6 to 5 billion, or I guess 8 to 5 billion, depending on how good of a year you have and how much is commissioned. And that's another thing, Chris. Well, I guess granted, 2022, you weren't fully commissioned as of yet, nor was the facility online on January 1. So you kind of have this partial value here in 2022, 8 billion in 2023 with elevated LNG prices. I think they were getting like $14 to $16 an MCF. And then here in revenue, you saw it drop off drastically to $8. So, but even still, the cash flow from operations that they got per annum was still pretty healthy. $2 billion that we're getting now through the trailing 12 months. It's something to scoff at here, especially knowing the fact that we're about to bring on a second facility. I'd expect this by the end in the fourth quarter of 2025 to be very healthy. Then you have the EBITDA of about 2.2 billion. Last year, the EBITDA was 5 billion. So imagine the amount of money you're making associated with that. Operating income this year dropping drastically. I think a lot of that has to do with the spot prices on the market being a lot worse. And then obviously net income dropped drastically because you have the depreciation costs started to come through. So when you talk about what exactly you're making, you should really be looking at an EBITDA to operating income basis, because as you've seen and as you will see, there's a lot of CapEx that goes into here. At the moment, they've already had about 26, and this is within these 2 years. I could go back probably to 2018, 2019 when the CapEx really started. But just in these 3 years alone, you have 26 billion in CapEx being kind of done, and a lot of debt being issued, 37 billion of debt issued just in these 3 years alone. But here you go back to the debt repayment. You had $5 billion in 2022, $6 billion in 2023, and it will be over $2 billion, I'm sure, in 2024. That's 12.6 billion in payoffs since they've been able to turn on that first facility. Now, keep in mind, they only have $22 billion of net debt. They have about $4 billion in cash, $4 to $5 billion in cash, plus the 1.5 or so billion that they just got from the IPO. So, in my opinion, these guys, once they get the second facility online, they'll be cruising. And will they actually need, that other half of a facility full of spas? I don't think they will. I think they could be able to sanction that third facility on their own based off the cash flows that they have, and get it online within 2 years, and really to start to move some gas around the world, and really get some good shit going. But it's interesting, man. I'm curious to see how it continues to go going forward.
What's interesting is when they first declared their S1, I was shocked at the price at which they were trying to go public.
Yeah.
I looked at it, I was like,
nope.
100. I was like, whoa, 110 billion? Like, are you guys smoking crack here? Like, what the hell is going on? Like, which idiot banker told you it was a good idea to put yourself at that level of evaluation? Especially considering that you're still early, you've got this arbitration hangover over your heads. Like, what the hell is going on here? And then I realized what happened. I think the Chase guys, I think it was Chase or I think Goldman, one of them, they looked at everything and said, well, let's try to value this based on 5 years out and hope, and the market will recognize that. Yeah. No, they're not going to recognize it because they're going to look purely at you being Shanir's cousin, right? You're not Shanir's cousin. You're trying to be like ExxonMobil's adopted son. There's a big difference. So I think what it is they messed up on the valuation, and they initially came with a really, really high price. They saw that no one was buying it. Like, I still remember the conversation, like, like, this thing's coming online. This is going to be great. And then me and you took 1 second of the math. We're like, nah, not at 110 billion. Like, I was, what's this saying? I wasn't born yesterday,
Yeah.
So
it was really sad, man, because you and I were like, you brought it to my attention, and I was like, no shit, because I remember we talked about it like 6 or 7 months ago.
Yeah.
And I was fired up. And then you told me, like, Matt, it's coming next month. I'm like, no, really? And then I saw it come across my Fidelity email, and I was like, what? And then I messaged you, and you were like, yeah, 110. And I was like, no, like, not at all. It just doesn't make sense. I mean, to me, I think the company will get to maybe more than 100, depending on how spot prices are. But I view this in a fully fleshed out business with it up and running, at least over 100 billion. But I think it's going to be close to 120 billion. And then with the potential for spot prices, depending on how that interacts with the EBITDA growth and everything of the like, because I've never seen that. I've never really seen what it's like to be on long-term spot prices for a company like that. So if you have 25% or more of your facility able to be sold at spot prices, then you have the additional facilities. Who knows as to how much those will be sold, if at all, because currently the third facility is only half sold. Then if you have that much excess capacity, really, I mean, this thing could be sky's the limit, especially during really good times. Because you think about it, if you're able to pay off 1 or 2 good years, if you have all 3 of those facilities pretty much 100% owned by VG, no spas, in a good year, you could pay off all your debt within 2 to 3 good years of run rate. And next thing you know, you're sitting there, zero debt. Unlike Cheniere, right? Cheniere has still a lot of debt still on the books. So it'll be interesting to kind of see. But I think that this thing could easily go down to $13 or $14. I could easily see that, but it doesn't mean that it will, right? It all just really depends upon what the market sees. And I have yet to really see an idea as to when the fourth quarter earnings are happening. And so I'm trying to look for it, because that'll be interesting, because that'll be the first time that management really has to get in front of anybody and give a presentation. And I'm curious to see what the sentiment looks like.
Look at the spot prices, by the way, for the year. They've doubled from March, it was 22 TTF, and now in the EU, now it's almost 55. How crazy is that? Dude, I'm telling you, this is going to be a very, very interesting company. There's definitely risks involved with it, but I think once these guys are up and running, it'll be good. It must suck to be that to be that banker who is trying to do the valuation for these guys and saying you're going to actually get customers to pay 110 billion market cap. And then they had to go down. I mean, dude, it's half that right now. Less than half. Someone got fired. Someone definitely got fired. I feel bad for the poor soul. That must have been really bad, man. But at least there are people out there that see the potential in this thing. So,
I'm trying to find what Gulf Coast spot prices are. Let's see.
Yeah. Oh, by the way, there wasn't enough demand, so they actually had to exercise the green shoe for these guys. Did you see that where the banks had to take a bunch of ownership?
Yes, I did see that. Yeah. Where is it? Platts. Maybe they have it on images. I'm trying to find Platts. TTF, that's TTF. I'm basically just trying to find the spot prices for LNG at the Gulf Coast. But of course, I'm just trying to see because it was basically I was utilizing the S1, and the S1 was basically talking about how in 2023 they were able to sell at $16 an MCF, MMBtu rather, and then this year they're really only getting about $8 to $9. And so that's obviously been part of the reason why the revenue's gone down substantially. So I want to see if that, with the fact that TTF is turning in the opposite direction, is it increasing over the year or is it still, and I haven't been able to find it. So Platts Gulf Coast marker. Let's see. Futures quote, CME. Damn it. Maybe this one. No doubt. You bastard. Okay. Well, do you want to talk at all about how it's different than NEXT, or do you think that that's sufficient enough? And
I think that's sufficient enough, man. I'm still long on NEXT. Don't get me wrong. There are some interesting things that have developed that me and Matt are going to keep to ourselves for now when it comes to NEXT. But NEXT is also good value in the future. So, this is not a buy, either or situation. There are multiple companies that are out there right now that are going to do well in this space. I think next decade has some real good opportunities in the future as well. So one of the things I did today, I sold half of my NEXT position and I bought Venture Global with it. Not to say that I'm not long on NEXT, because I'm still very long on NEXT, but I just want to make sure that I have a diversified thing. So, why bet on one horse when you can bet on two?
Yeah, so I was curious about that. I wanted to poke your brain because what was it, just so that you would be able to have ownership in both? Or I was just kind of surprised that you would sell a large position in NEXT because we're still pretty bullish on it.
Yeah, well, there's a couple of reasons.
One, I don't want cash elsewhere, or
yeah, well, that's the other thing. I don't want to go beyond my portfolio allocation for energy. I've been burned by that in the past.
Yeah. So
the thing is, like, I didn't have any cash on the side to buy anything. Like, I'd have to sell other things just to buy this one. So instead said, all right, you know what? Let me cut my natural gas, which is my energy position, and just move it over here. Now, what I do plan on doing is if NEXT takes a bit of a hit and goes further down, any additional cash flow that I get after paying taxes are going to be distributed primarily to next decade.
Mm-hmm.
Yeah. The other thing is with Venture Global. Remember, they haven't even reported their first earnings yet. And I think what happens is if they report their first earning, then they absolutely kill it. This could be a V-shaped recovery back to the 25s and maybe even the 30s, you know? Whereas NEXT, I think that they're going to top out at 10 until they get the FIDs on terminals, phase, was it phase 2 and phase 3? But the thing is, those are not going to end up being done with litigation until I think it was August or something like that, right?
Mm-hmm.
So there's time where you can wait a little bit. So
yeah. I mean, there's more of a binary impact, I think, with next decade. I don't think it's going to go to them this way, but with litigation, there's always the surprise that they might have to cease. But they're still constructing as we speak. They're working on trains 1 through 3, and the ownership of the next decade owning that equates to about 3.6 MTPA. So to me, with just those, you're technically, if that comes online just for that, you should be able to increase your amount within next decade by at least 100% with where we are today, at least in my opinion. Then if you take in trains 4 and 5, and we won't talk about anything other than that, then really you could get yourself to a place where $10 billion market cap for that sounds about reasonable. And then if you have buy downs and buybacks, etc., then could be great. The problem is the real money with a lot of this stuff isn't necessarily made in the LNG train. Yes, it makes money, but really the shipping and trading, right? Because what you're basically saying is no matter what, you have a contract for gas coming off the Gulf Coast, which is massive supply, versus where the EU and Japan, etc., don't have the supply. So they're going to be paying way more. So in my opinion, until you get to a place where you're in the mid 2030s, it's going to be very much a world that is washed with oil, but not awash with natural gas, because we're still getting the channels up and running. So with that, just keep that in mind. Basically, the way I like to put it is Venture Global has projects online. They have 2 projects now. We'll find out more about how the quality of the second project is progressing throughout this year. Next decade, you don't even have a project that's online yet, and technically isn't even allowed to export trains 1 through 3 at the moment until they get some of the litigation piece over and done with. So to me, it's a question about risk tolerance. The return of next decade here is likely much better, in my opinion, but you're going to have risk. But Venture Global at the same time, it might take a while to get there. They could actually be equal, in my opinion. They could be equal returns depending on how aggressive and how much upside we see from the spot prices and the ability to buy back stock and in the long term, which, that's a gamble. But to me, in the shorter term, in the next 5 to 10 years, I think next decade, if things go well, will be a better return than Venture Global. But Venture Global, I think you can, aside from the next year where I think there's going to be more ups and downs, I think in the next 5 to 10 years will be a much easier sleep well at night stock. So it really just depends upon what your risk tolerance is. But once again, if it's something where you don't understand it, or you're afraid of the volatility of it, or you're not ready for a 5 to 10 year commitment in a position, then don't buy it, because this is going to have ups, downs, and sideways. It's not like it's something like Coca-Cola, right?
Yeah. One of the things I just want to highlight is there's another creator who watches us, and I've watched his videos a couple of times, Dustin Dollars. Shout out to him. He does great content on this. The only thing I'd say is he did a valuation model on Venture Global that I think is right in how he's approaching it. But I think there are other portions of the business that are a lot more going to be based on spot pricing and the vertical integration piece that we spoke about that may not necessarily lay 1-to-1, so this is where I'd say it's really hard to value this company, because
I have no idea.
It's really hard to value the company, and it's also a lot of execution risk, right? along with it. Now, the thing is, you're getting paid for that execution risk. In my opinion, just like you said, I think in next decade as long term, the potential is definitely for higher amount of total capital appreciation upside, but there's
The risk.
also risk.
Yeah.
But this one is less risk, but could also have the similar upside if they do everything execution wise correctly.
Yes.
And if they don't get there, there's still upside, but it's just not as much.
Yeah.
You know, so
it's almost like you could sleep better at night, get maybe 50 to 60% of the same return as you would for next decade is kind of where I'm at. Maybe it's 40 to 60, you know, but you're getting about, you're not saying 40 to 60% return. I'm saying the total amount of upside that I see for next decade, which is in several 100%. You're going to be able to get 40 to 60% of that with a lot less volatility and risk with venture global. But next decade, if you're willing to take that and eat that and have confidence that we're in the right administration and that they have good partners that will make sure that they don't screw up, ADNOC, Mubadala, not Total, well, I guess it is Total, and others.
GIC,
Then,
GIC.
yeah, GIC, yeah. So, yeah.
Singapore, I think Singapore was the GIC, right?
I think so.
Yeah.
Anyway.
Yeah, it's a very interesting place to be. The good thing is, when it comes to natural gas, oil, and stuff, you're definitely going to be exposed to underlying commodity prices and demand, but the business model here is less so than if you were just pure upstream. The challenge with energy is which part of the mechanism are you part of? Are you part of the upstream? Are you part of the midstream? Are you part of the downstream? And each one carries a certain risk. Upstream has the most risk, but it also has the most upside as well. You know, so if you find the right company who knows how to basically buy things when they're cheap and sell things when they're expensive, they're going to do really well. On the other hand, midstream, it's more for people that are looking for strong, stable cash flows over a long period of time. So guys like Steven love companies. Like that's why Steven is a big believer in the pipeline companies. You know, he loves what is it? EQ? No, fair which one? Equity part. Steven, which one was it?
I don't know.
EQ, whatever. But basically that's what it is. Yeah, the other thing to also I really like about these guys is they are C corps. You know, other LNG companies that I know, they've have like different weird structures that basically where you're almost like a partner and you have to deal with that whole thing. This is, you can just buy back a whole bunch of shares and basically boost your stock price. You know,
and another thing which you already talked about, but I want to reiterate, Chris, like while we're talking about the differences, regasification plants, man. So S1, I'm just going to read this directly from it, or at least an overview.
Yeah,
of it.
share the screen. Energy transfer. Thank you, guys. Energy transfer.
Yeah, ET. He loves ET. EBT. He loves everything. So this is kind of a let's see, utilizing notebook.lm. So it's a little bit of a cheat, but dang, it's going to pull this crap on me. But let me just scroll through this. So can I hide this? That helps. So Venture Global is seeking opportunities for LNG regasification capacity in key markets. So in Europe, Grain LNG, which is in the UK, expected to allow the company to import 42 LNG cargoes per annum for approximately 2029 to 2045. For some reason, only 13 can be imported, I guess, between certain times in 2030. Okay, cool. And then they also have 1 MTPA of gasification in Greece for 5 years, starting in 2025. So that's going to be something that we can at least account for this year, but which I've never really seen before. So how to include that in the financials, I don't really know. And this accounts for approximately 25% of that particular regasification plant, which is about 12 cargoes per annum. And so that's a whole nother piece that, if you think about it, adds additional financials to that integrated shipping business. Who's to say that once they get more of these deals done, are they going to deal with stuff in South Korea? Are they going to deal with stuff in Japan, where they deal with these regasification facilities and get those contracts secured? It's going to be really interesting to see. I don't know. And that's something that I think is something I'm going to be particularly looking at as a difference between what's going on with Cheniere and what's going on with these guys at Venture Global.
Did you notice that they're cutting a lot of middlemen out? EPC contractors out, shippers out, what are they called? Regasification out. Like they're literally like, we'll do everything ourselves. I mean, I'm telling you, they really are trying to get to Exxon.
I think that's why the Total CEO isn't a fan, because you think about it, he's got the Rio Grande. He's got the Rio Grande LNG facility that's literally coming on. It's been taking forever, right?
Yeah.
And so you have that, and then Total is huge in LNG. I don't know if people know that, but they're massive in LNG worldwide. They do a lot of Africa. They have a lot of stuff in Mozambique. So I don't know if they do much in Australia, but they definitely do stuff in Indonesia and Papua New Guinea. So familiar with that.
Actually, now that you mention him, that makes total sense. Like, why?
That's why when the article came out, everyone was like laughing about it. And I'm like, it's gossip. He's a little gossip queen.
Yeah.
Sorry, I shouldn't be saying that because I might get in trouble when I get into the office tomorrow. But I mean, come on.
That's so true, man. I didn't even think about that. Like, why would you want to buy cargoes from your freaking future competitor?
It probably was something. It was probably a deal gone bad. Hey, we want to buy 10% of the facility. No.
Yeah.
But no, we're not going to do a spot with you.
Yeah. That's the one thing about these fucking French, bro. They're ruthless, okay? The only thing that's more ruthless than a Frenchman is an American entrepreneur, bro. When they get together, they clash, baby. We clash like there's no tomorrow. America.
But no, I mean, I think you're onto something there, Chris. I think what Venture Global recognized is a lot of finance folks that decided to get themselves into something. Like Bezos, right? Bezos was in finance, and he said, "Holy shit, look at this! Like the e-commerce."
By the way, the founders of Venture Global, they're investment bankers. Okay,
yes.
They're not.
Yes.
So they know what the value of all this stuff is. They're not like they're not like the pushovers that are just like, oh yeah, we're gonna try to make this work. No, these are ruthless businessmen on the other side of this.
And maybe it's because I work for UDOC, and I don't want to say too much on this, but you'll see how people can really make a name for themselves and get some real good margins. But you think about it, if I'm drilling an oil well in the Gulf of Mexico and I have to source steel, I don't have somebody on the ground in Mexico or South America sourcing steel, right? I have somebody that I contract that sources steel globally, who then sources steel from somebody else, who then sources steel. So the amount of times after I actually get the steel that I've had somebody's hands touch it, I've had somebody add another 15 to 20% on top of that price of steel. You think about it, you're probably paying 2 to 3 times what it's actually worth, based on the fact that you're trying to outsource it a little bit, just to make it slightly quicker, slightly easier, etc. But I think in all times, so I think that's probably what they recognized. They realized, what do you mean we're gonna have to pay? Like, we're gonna have to get somebody to not only come to us, but then we're going to have to let them do the win-win sort of situation. We're going to be reliant upon them to get our facility built. We're going to have to do this. We're going to do that. We're going to have to do the other. And then we're going to let them get the upside if the spot prices are good in Europe and Japan. So they probably sitting there like, we'll get ourselves and foots on the ground, basically get to the size of Cheniere and fund ourselves. Because that's really the only problem that with Cheniere is that they're almost done and they're almost at capacity.
By the way, these guys, they're part of the Mar-a-Lago crew. So the CEO was actually hanging out with Trump at Mar-a-Lago during their inauguration. See, people don't know that. So let me just quickly show you guys the thing from CNBC. So this is their CEO, Mike Sable.
This was not a good.
Joining us now is Venture Global.
Second. Don't worry, this won't get demonetized because the CNBC doesn't do that. Don't worry. I know we got demonetized yesterday because I showed one clip. I'm sorry.
No. I said this wasn't a good interview on this guy's part, but yeah, it's still worthwhile.
CEO Mike Sable. Mike, nice to have you. Congrats.
Great to be here. Thank you very much.
How do you differentiate your company from competitors such as Cheniere or Freeport, which is a private company? In reading the S1, it seems to be in part the way that you actually manufacture and construct your trains. in terms of a different way and perhaps more speedily. Is that correct?
No, that's correct. We're the first ones ever to shrink the size of the liquefaction train to where we can build it in a factory. And it's originally how my partner and I, Bob Pender, were thinking about it, is really Dell servers with AWS replacing IBM mainframe computing. And that actually was part of the conversation that we had way back with Jeff Immelt 14 years ago.
Does that enable you to do it at a cheaper cost? And I wonder, I mean, so many of these things still have cost overruns. You manage them in a way that perhaps your competitors don't as well. Is that fair to say?
Yeah, we think that we're by far the lowest cost liquefier in the world. And it's an exported gas market, so it's a commodity market. So having low cost is key to rapid growth. And I think we're one of the fastest growing energy companies in the world right now.
You are in arbitration with a number of your key customers. I think 7 of your originals, including BP and Shell. Trying to understand it myself, but it seems as though they claim that you're selling at a much higher rate right now and not honoring their contract.
You're on mute, Christopher.
He basically wanted to say, like, you ripped them off, but he's trying to, like, find the words to be polite and not say that, you know.
What do you tell people about that arbitration in terms of why you think it's not going to be perhaps a threat to your business?
Yeah, it's not. We're absolutely consistent with all our contracts, and we use the same contracts that the entire industry uses. They're all dictated by the project finance banks. When we complete Calcasieu Pass, which is the facility that you're talking about, will be the second or third fastest facility that's ever been built. And our primary regulator is FERC, and FERC has said we're not in service, we're not complete, and until you complete the facility, we're generating commissioning cargoes. But because of the unique way that we produce our liquefaction with our modular trains, we produce a lot more during construction than anybody ever has before.
He sounds so freaking like, he sounds like a snake, but he's our snake. I like that. You know, it's like, you're a ruthless vato, but I like that.
All those customers know that, and ultimately they'll enjoy all 20 years of those contracts, and they haven't lost any money at all.
But right now you're able to sell at a higher price than under those contracts.
That's correct, because we're not complete with the facility.
So what happens when you do? Does it then bring your profitability down?
Well, we have another facility coming right behind it that's twice as large, and then in fact the third facility, we're taking delivery of our liquefaction trains the end of next quarter. And so
wait, I missed that. I missed that. They're getting the
it,
trains for facility number 3 at the end of the 1Q.
Well, not only that, but remember the train that just got started commissioning, they're not going to COD for another 2 years.
Oh, yeah, not until 2027 for sure.
Right, so they're going to be selling into the spot.
I'm not concerned about that. What I'm concerned about is I'm not concerned about it. What I heard.
Let's go back.
What I heard was that they're going to start getting trains for the third facility before it's even FID'd. That's
not.
Let's listen. Let's listen.
But right now you're able to sell at a higher price than under those contracts.
That's correct, because we're not complete with the facility.
So what happens when you do? Does it then bring your profitability down?
Well, we have another facility coming right behind it that's twice as large, and then in fact the third facility, we're taking delivery of our liquefaction trains the end of next quarter, and so we're ramping up again, the fastest in the world. And
whoa! You heard that shit?
That's what I just said. Yeah.
Huh.
I didn't when I listened to this a week or two ago, or on IPO day, which I guess was 3 Fridays ago. I didn't hear that line before.
Damn. Telling
I did not hear that line before. I knew, because I scoured the S1.
Yeah.
And I saw that they've invested over $3.5-4 billion. But I had no idea anything about that train. But I mean, how long does it take to commission that? I don't know, right? Like, all I know is that they get it done within 2 years of FID. But is that because they're getting, like, Is that normal for what they did for Calcasieu Pass and in the second facility? I don't know.
Let's do more research. Let's just do more research.
And with that facility, with the largest producer in the United States and second largest in the world.
Wait, so they are planning on producing from that thing before FID? Because he just said we're going to be the second largest. Matt, we'll take this offline. Let's dig into this a little bit.
Okay, I was going to say
I'm glad you caught that. I didn't.
Well, I'm going to re-listen to it. Yeah, but
yeah,
don't.
Ultimately, what does that mean?
Yeah.
For financials? Because I know you said that you're among the fastest growing.
We are.
But I'm looking at your S1 and I see in the 9 months through September that revenue declined. That amount came in about half the amount that it was in 2023.
Down.
Same too with the bottom line as well. So by what metric are you growing and when does that filter into actual financial growth?
Well, what you're looking at there is when you put trains in service under GAAP accounting, you switch from income to actually accruing and net the cash earnings as just reduction in the capital cost of the facility. So the cash earnings were ramping up, but the accounting treatment as you're turning the facility on changes. So the steepness of the cash earnings is actually significant.
So then what are you projecting for this year?
All right. So that's one thing that we're gonna have to keep in mind, because I think that's true. Whenever they do GAAP, where they don't include they do include depreciation, it looks like they're not generating as much, but cash flow wise, which they can use to reinvest, is going up.
Yeah.
So
that's why I always tell people, like, capital intensive businesses, you really have to keep track of that, because you're like real estate, right? It's almost like how you look at it, a price to funds from operation aspect of things. Companies like oil companies and LNG companies, you should really look at things on a price to EBITDA, which you have to keep in mind is you need to be cautious, but really it's more of like a price to cash flow from operations. Because of that fact, you have so much, and at least in oil companies, you have something called depletion costs, which you understand, like let's say you have 1 billion barrels and it costs you $1 billion to be able to produce that. Every barrel that you produce, you get $1 of your net income dropped off of that. So even if you're, say, selling it at $60, really, and your profit margin is, let's say, 50%, you're basically going to say, well, I grossed $30 for this, and that's what my cash flow is. But really, it's only going to show up as 29 because you're able to have depletion costs associated with that. Yeah. So that's something to be aware of. And that's just like a very rudimentary example. But what these guys are saying is we're going to produce really good ops cash, but on a net
and use that
basis,
use that ops cash to reinvest in the other facilities, which means that they're not even going to have to do 20-year spa deals. I saw that in their S1 too, where they can do 5 and 10-year like lower duration spa deals and have more margin on them, you know?
Yeah.
So
what it's basically saying is, yes, I mean, the operating income also went down pretty substantially, but the net income, of course, this is for the first 9 months. So I'm comparing 9 months to 12 months. But if you look at it for comparison to the first 9 months of 24 to the all full year 23, you're down 60% for operating income, but your net income is down over 80%. Keep in mind, it's going to grow as you get the fourth quarter of earnings. But it just goes to show you that operating income is much more resilient than the net income due to the fact that you have that depreciation piece.
Yeah.
We had significant earnings growth. We're going from operating 18 liquefaction trains to, on our way to 54, on our way to 90. And so as you turn on a train.
Never mind. We'll talk after.
Yeah.
We'll talk after.
I that number's just I didn't factor that in, but let's keep going.
That produces
there's nuances to it. We'll talk after.
You earn a lot more money. Ultimately, our business is that we manufacture and operate machines that produce money, manufactures a commodity, and gas is one of the most important in short supply commodities in the world right now. And with the investments in data centers, a lot which is going to have to be supplied with growth in gas-fired electricity production, we're in a very key position.
Simple Minds, alive and kick.
You're on mute.
No, I just hope the stupid commercial doesn't demonetize us because, you know.
Yeah. All good. Interesting,
so
man.
we have more homework to do, basically.
Yeah, no, yeah, for sure, we definitely do.
Homework to the upside. Homework to the upside. See, now I'm starting to understand why why Chase was trying to get these guys to IPO at $50. It's starting to make a little bit more sense. Do you notice that now?
I mean, I was never I'd be pissed if we got demonetized. Like, you showed this ad. Yes and no. I mean, I see the long-term potential, right? When I was doing the numbers initially in my head, just thinking about it, I was thinking that, okay, it's going to be in the long term valued anywhere between 100 and 150 billion, before I really knew much about all the difference and nuances with respect to the spot prices, the regasification plants, the integrated shipping piece. And it wasn't until I started reading through the S1 where I realized that there's potentially more upside than that. So, but yes, at the 110, it just didn't make sense. It was like, okay, you have, it's like buying Palantir today, right? Maybe not to that extent, because Palantir, in my opinion, is way more overvalued than $110 billion for Venture Global. But you're basically buying it almost at, several years down the road's sort of earnings. Like, if the train 3 was fully online and commissioned and you're just to start train 4, I can understand if you wanted to value it at 110. But the fact that before they had literally just sold one LNG ship from the second facility, and they're trying to get 110 billion, in my opinion, it was just too premature to ask that sort of valuation.
Yeah.
No, I have not sold Palantir, but I'm bearish on it in the short term. Cool.
Man, Palantir is just whatever. All right, man. This was a pleasure. Thank you guys for joining us. This is how sometimes investing with other professionals works. You basically run ideas, and sometimes you discover things on the fly, and it's a really interesting thing. But me and Matt are going to take this offline. We're going to have some conversations. We might bring the brain trust into the mix and see where we go with this. But yeah, I think we're in the right direction. We're headed in the right direction.
Yeah. And it could, like you said, I think you said it eloquently earlier. Could it go down a little bit more? Could it go to 15, 14? I think so. It could, but you don't know. And people were saying the same thing about Rocket Lab. They're like, oh, it's going to retrace back down to $8. And when it went down to 13, oh, it's going to retrace down to 10. You never know. And so if you can say with your hand over your heart that you think it's going to be worth more, 5-10 years from now, and you're still going to double your money, then what's the difference of buying it at 17 or 18 versus buying it at 15, right? You're still going to almost double your money, depending on if that's where you think it's going to head. And you could miss out on not getting a double if you never get to the $14 or $15 range. So to me, I dabbled in, I have monthly buys, or it's not monthly, twice a month buys set up for the middle of the month and end of the month. That's when I get paid. And part of my paycheck's going to go into buying this for the next couple months. And like if SMCI, which we'll find out a little bit about next week, if that moons, then maybe I take some profit off the table and put it into this. So,
Yep. All right. Let's have a discussion later, brother.
Yeah. All right. I'll see everybody the next time. Thank you for joining us for the emergency meeting. Really good attendance.
SMCI next week. Like, before we go, maybe we'll just do a quick extra.
Yeah.
Dude, if SMCI reports,
did you see Amazon's numbers, or you just wake up?
No, I saw.
Guess what they forecasted for their capex?
100 billion, right? Something like that.
Yeah, 110 billion.
Yeah. Just remember though, not all of it is in data centers. Some of it's also in like other parts,
facilities, warehouses for Amazon.
Yeah. So no, dude, Google and Amazon are both. And it's funny because I think they use the same thing. Like I was like in and out of sleep, so I couldn't really what's that thing called? Listen to it, but I think I heard their supply constrained. That's one of the reasons why they didn't do as much in growth in cloud compute. So, if that's the case, bro, these are cash flow machines, man.
Dude, if I had more money, well, I do get my bonus in March, so if they're still depressed, maybe I'll
one day we shall launch a fund, and we shall actually make real money.
That'll be fun, and hopefully make money for others as well. That's the goal.
Yeah,
And take a cut.
And take a cut.
And take a cut. Exactly. All right, everybody. We'll see you next time. Thank you for joining the emergency stream. Especially, we had over 250 people for almost the entire 2 hours. So I appreciate you guys showing up for the second day in a row. Over 200 people. It's a joy for us, and hopefully we can get to the 300s, 400s, 500s, and eventually be able to do this way more often. Chris, that'd be the goal. Have no constraints. We'd be able to spend more time and focus. Like, ooh, we have an hour-long show this evening. We got to prepare. That'd be fun.
Yeah.
Cool. See you in the back end.
See ya.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.